this is Rachel from Kalkine Media and you're watching Kalkine Media's educational series. Please subscribe to our channel and press the bell icon for notifications for our latest videos. A number of investors and experts have grown increasingly concerned over inflation over the past few months, at a time when inflation seems to be on an accelerating path. Some economic indicators hinting towards increasing inflationary pressures demand closer attention. Some of these indicators include rising employment levels, increased economic growth after a period of slowdown, and of course a short-term rise in commodity prices. Even short-run inflation can be the sign of an impending price rally in the long run. Inflationary fears are generally heightened when an economy is emerging out of a recessionary phase. During such a time, it is expected that industries would not immediately have the capacity to fulfill demand after an economic slump. Therefore, most industries become incapacitated and fail to meet market demand. This could mean a supply shortage, which ultimately fuels inflation. That is why inflation expectations are objectively high when an economy is in a recovery phase. In addition, a massive government stimulus, which is often provided after an economic slowdown, points towards the onset of a price rally. Let us take a look at 5 reasons why growing inflation anxiety is a reason to worry. Firstly, there is a risk of currency depreciation. High inflation could mean a fall in the exchange rate when the domestic currency is undergoing inflation. When a country experiences inflation, the domestic currency loses value against foreign currencies. If the currency losing value belongs to the importer nation, the partner country or the exporter earns more for the same amount of goods exported due to the fall in the value of the importing country's money. At the same time, the country experiencing inflation suffers a loss in its exports too. Consider the case of Australia and its iron ore exports. Once inflation sets in, the amount of money received from its trading partner when converted into the Australian dollar would fetch lesser returns than before. Therefore, a fall in the Australian dollar to the US dollar rate can be expected in case the inflationary pressures grow in the Australian economy. For central banks, prolonged bouts of inflation could be a good enough reason to act. In such a scenario, central banks usually respond by raising interest rates to discourage borrowing. Raising interest rates de-incentivizes loans and reduces the amount of liquidity in the economy. Interest rates are a monetary policy tool that can alter the amount of liquidity in the economy. The increased cost of borrowing, for example, increased interest rates, leaving lesser scope for spending in the economy. Instead, saving seems to be a better option due to the higher rate offered in such a scenario. In contrast, if interest rates are not reduced, then the pre-existing debt becomes cheaper due to inflation. The real burden of debt seems less because a fixed amount is to be paid in every installment. Inflation is usually not a good scenario for industries and manufacturers. Rising prices simply means bigger production spends and higher debt for firms. Inflation may also eat a portion of the profits earned by specific industries operating in the economy. When producers anticipate a rise in prices, they generally stock up on raw materials. Hoarding of materials can have serious consequences on the economy at a time when consumers are already coping with highly inflated prices. This only increases the cornering of commodities. There is also a risk that production channels may come to a standstill. This is what we saw during the COVID-19 lockdowns, which can take firms much longer than usual to meet the growing demand. This may mean the period for price rise stretching out longer than anticipated. As a result, the hardest hit sectors offering less wages would see workers leaving their jobs. This may point to a scenario where there is not enough supply of labour even after the effects of the recession have dried down. There is also the threat of stagflation. According to the Phillips curve relation, rising inflation generally means an upswing in employment in the economy. The Phillips curve equation draws an inverse relationship between unemployment and inflation in an economy. However, as unemployment falls, employers are expected to pay higher wages to their existing workers. Higher wages are the forerunners of increased liquidity in an economy. With greater wages, consumers have more cash available at their disposal. Increased spending heats the economy and can cast even longer inflation spells than those currently in place. The situation is even worse in developing nations where economic growth is slow. The state of low economic growth, high unemployment, and high inflation gives rise to stagflation. Simply put, stagflation is an economic situation where the inflation remains stagnated for a long period without any economic growth happening. In such a case, productivity also declines. While low to moderate levels of inflation can spur economic growth, a runaway inflation obstructs the growth in an economy. Governments receive greater revenue in the form of higher tax in mild inflationary periods. This could set a perfect ground for greater public spending and influence economic growth. Additionally, internal trade and business can also thrive amidst mild inflation. Long-term inflation, on the other hand, is an issue of concern. Even with increased government revenue, investment and development, projects become expensive and are obstructed by inflated costs. Inflation eats away the value of money and reduces the rate of capital formation, disturbing the pattern of consumption. This can lead to serious shifts in consumer behaviour and slow down economic growth. Now, if you like this information, please like, share and comment on this video and subscribe to our YouTube channel. Press the bell icon for notifications for our latest videos. For regular updates and information, log on to our website, kalkinemedia.com. I'm Rachel Jones, signing off for Kalkine Media.